G'day listeners and welcome to another episode of the Scouting Australia podcast, powered by Australian Property Scout Buyers Agency. I'm your host, Sammy Gordon, and today, guys, we are back for another APS Weekly News Bulletin, keeping you up to date and well informed on the Australian property market. And we have a very special guest. He's commonly written in himself to try and take the co-host job from Jimmy Ibrahim. And occasionally we have guests, listeners also write in and request it, but they are few and far between. I'd like to welcome back Mr. Magic Mike Mortlock. Mate, welcome back to the show.
Thank you. There's a lot of power. And yeah, normally that's my mum. I set her up with a few different Gmail addresses.
A few different accounts.
Yeah, we hit critical mass.
Okay, beautiful, mate. Well, welcome back, man.
Thank you.
Everyone loved having you on last year, mate. We had the big depreciation masterclass with Magic Mike. We had, I think we did the stats one and a bit of movements and whatnot in the last one, mate. And it was very well received, man. A lot of good information and a lot of people love the depreciation side, mate.
Do they?
Yeah.
Thank God for that, because I've got nothing else to offer, really.
Mate, I was surprised that an ep about something that would be normally considered as boring as depreciation, it was actually pretty funny, man. So, well done.
Beautiful. Well, set the bar high for this one. We can only go down.
Mate, today we're talking about specifically the Victorian market, but we're also talking about kind of data points and trends right across the country that you're seeing, because you have a really, refined look at what investors are doing out there in the marketplace, for one, being that depreciation reports and what you see being produced or being sourced and bought for one, buyers agents, but for two, private investors, and then what they're ordering reports on.
Yep.
So you guys are able to kind of closely track and monitor that from that side, but obviously you guys also get a lot of data points outside of that as well, right?
Yeah, and data points that don't exist anywhere else. Like say, for example, we were the first people to say that on average, just under 25% of investors occupy their investment property prior to renting it out.
Is that right?
Yeah, which is a huge figure. And it floats between sort of 22 and 24%. It's way higher than I would have expected. And
is that primary residence? Like people have bought them as a primary residence and then convert it to an investment?
Yeah.
Interesting.
Yeah.
Wow, so that's massive. And do you find most of those are like the first time buyers, like doing the little sneaky, we'll move in there first?
Well,
or it's more people just wanting to hang on to that primary residence?
That's a really good question, and people asserted that must be what it is.
Yeah.
But when we first crunched it, the average time that people occupied was 4 years.
Oh, wow.
So that kind of smashes that notion, because you only need to be in for, 6 or 12 months depending on the state. Yeah. So that would certainly be true to an extent.
Yep.
But if that was the only story, it wouldn't be an average of 4 years.
Yeah. No, that's quite long.
So I love that. I mean, anything that we can collect. I like just telling stories about what happens. You know, it's not a prediction; it's what happened and what people brought to us.
Yep.
And the good news is that it normally used to take around 3 or 4 years between settlement and getting in touch with us.
Yep.
So it was quite lagging.
Yes.
But now it's around about 75, 76 days. So it is fairly close to
2 to 3 months, like it's that close.
Yeah.
Wow.
Yeah.
What do you think's been the shift with that?
I think it was the last show we did, to be honest.
Okay.
The education
it makes
out
sense.
there. I mean, I've been talking about it for, I don't know, a long time, 15, 20 years or something. So the education's out there a little bit more.
Yeah.
But I think also buyers agents as an industry probably have a claim to that number.
Yeah.
Because typically the main sort of introducer, for want of a better term, would be accountants saying you need to get a tax depreciation schedule. So you might buy something, you might buy it in August, you wait till the next July to do your tax return. They're like, have you got a depreciation schedule? And they go, what's a depreciation schedule? Whereas a buyer's agent, I think many of them, like yourself, have kind of figured out, well, this is a really easy thing to plug into my business and add value because people need it, right? If they're not doing it, they're leaving money on the table. And I've got some interesting stats on that too.
Ooh, okay. Matt, I think one of the other, the big things with it, exactly as you said there, with people getting more educated as well, I think more people listening to more content, and like, I know you're saying it jokingly, obviously, about us, but obviously people, following, whether it is their BA or following different people out there, different shows out there, from a property investment perspective, and realising that it is leaving money on the table, and it's something that they can get done quickly, then write it off that financial year, the cost of the report, but then also obviously the actual cost of the depreciation against their property too. I wonder, and you tell me if you've seen this, if in the last 2 years with interest rates where they are now, because I remember I was very lazy when interest rates were super low, and I'd probably acquired 20, 30 properties or something while interest rates were super low. And then I really just didn't even think about it. And then interest rates do a 4.25% bump in an 18-month window. And then all of a sudden, cash flows.
And cash flow's smashed. Like, what can I do about this? I'll give Mike a call.
Well, exactly, right? And when you think about it, like the average person, if like a normal bread and butter, like a growth property is running a few grand a year positive, and then interest rates do that, and they're running a few grand a year negative, and it's the way to balance the books and get themselves back in front. This is where a lot of people are kind of looking for those avenues, right? And it's a great way, especially from a cash flow perspective, to get to get themselves back in the green.
Yeah, when we saw interest rates increasing rapidly, such as they have, like it's never increased more rapidly than it has.
Yeah.
We definitely saw people getting in. They might have been positive or neutral, then they were firmly negative.
Yeah.
And they're looking for ways to improve the cash flow.
Yeah.
So, yeah, I'm hoping interest rates go to 17% because we'll be flat out.
Yeah, you'll be smashed.
There'll be blood in the streets, but we'll be busy,
That's good, mate. That's good. Yeah, I think one of the other cool things, like something that I love about it is like as soon as we finish a cash flow deal, we're like bang, jump on to like hit Mike up, because cash flow deal for us will be like, say, building a granny flat, and they might be renovating the front house, and the cool thing is obviously like you've got the lifetime write off of that property, and the immediate, especially those first like 3 to 5 years are so juicy, because of the amount of plant, right?
Plant equipment.
Plant equipment that they can write off so quickly in those first few years. And the cool thing is like after, let's say it's that 5 years of super juiciness, as a term
trademark.
there. Yeah, right. Well, I will trademark that. So the super juiciness of that initial write off, depletes to an extent after, say, that first 5 to 7 years.
Yep.
The cool thing is if you've bought in the right market, your rent should also have had a significant growth. So it almost like balances back out where, all right, your depreciation might peter off a bit whilst it's still there, but you've had the rental growth and probably the price growth and everything has come through at the same time. So
that's a good point.
And lowered the LVR too. So I really like it from that side, man. I love like ordering them once they're done. Like, again, we won't do it, and then all of a sudden you get like six grannies to go and depreciate in one hit. And it helps, man. Like it's a big, it's even from my end, my portfolio is obviously very cash flow positive, and it just like wipes out a piece of that tax bill that I otherwise would have had to have spent. So
absolutely,
it's cool, man.
It's really the second biggest deduction after interest.
Mortgage,
right? So you'll have repairs and maintenance. Sometimes you might have a big bill if you've got something going on. You'll have your PM expenses and those sorts of things, but depreciation normally really sits just after the interest payment.
Yeah.
And it makes a big difference. Like the hardest time, as you mentioned, to hold a property is in the beginning, because you may pay down principal, but even if you don't, the rents will likely go up.
Yep.
So the cash flow is tightest at the beginning, and that's where depreciation can swoop in with those, what was it, super juicy deductions?
Juiciness. The super juiciness. Yeah. I guess it depends on like where we're putting it in, the super juicy deductions. And yeah, man, that's nice. I like it. Trademark it. You should put that on the potty. This would be like a super juicy app.
Super juicy app.
Yeah, we'll talk about that.
Sounds like a chewing gum.
There we go. It's out. We're going to trademark that one. Well, we'll trademark that before it gets released. Super juicy.
Good.
All right, moving on. We are talking about the stats, the trends, what's happening out there in the marketplace right now. We're going to compare it kind of nationwide, but I know you were talking specifically about the Victorian market and what you're seeing there. Man, talk us through the numbers and what you guys are seeing from a data and a trend perspective.
Yeah, well, Victoria is a very interesting market. I mean, it's been in the absolute toilet in the last couple of years.
Dubbed Mordor, I believe. It's just one of those places you just don't want to go unless you're trying to dissolve a ring, destroy a ring.
Well, yeah, exactly. Yeah, the fires of Mount Doom.
That's it.
I was talking to a friend in Melbourne the other day, and they said it was 11 degrees and rainy, and I think yesterday here was 28.
28 degrees.
It's like this really is God's country, but
in winter.
Yeah. So if talking specifically on Victoria, and there have been two major sort of moves of state intervention into in property investing. The first one happened in Queensland, right? So if you don't mind, we'll take a slow tour down
Let's take a detour. Let's take a detour.
We'll take a detour. We'll start with Queensland. So we all remember the land tax legislation, right? So thankfully, because of the great work done by REIQ and Pippa, that was repealed. Unfortunately, they said the reason they repealed it is not because it was a bad idea, it's because the states wouldn't give them the data, right? New South Wales weren't going to give them their property investors so they can claim it. It was just insane.
Yeah.
But that we calculated that there was a 98-day period where investors would have been purchasing in Queensland with the full knowledge that this legislation would happen, right? Because it was enacted, it was legislated, it just wasn't happening until 1 July.
Explain that for a second. So that was because it had passed Parliament and it was coming in, but obviously land tax is calculated at the end of a financial year. So we hadn't. It was done it was in Q3, wasn't it? In I think 2022.
Yes.
And so they wouldn't have actually calculated calculated it until the end of financial year, which would have been June 2023.
July.
1 July 2023.
1 July, yeah.
So that lag period was like no one had felt the impact of it yet.
No.
Except for the Queensland property market because people stopped buying.
But it was priced into it, right? So there's two sides of the equations. There's people buying and there's people selling, right? So I don't have the data on the selling, but there are places like PropTrack that were saying a lot of Queenslanders are getting out of the market because they don't want to be hit by this when it happens.
We had a lot of our big investors say the same thing.
They
were going to be taking things to market because it's like it was just going to smash them a lot of the time because of what they actually held in other states like New South Wales and and Victoria.
Yes.
Because the rateable land value there was so high. If they grouped it, they were going to get destroyed.
It's crazy. Group it. And if you think about this, that land tax is a tax deduction, right? So for Queensland to grab all that national land tax, then you get a deduction. You're actually stealing tax from the federal government.
Yeah.
So it's almost like the state was kind of pinching it from the feds.
Interesting.
No one really talked about that. But what we did is we calculated pre that 98-day period that 40.9% of property investment transactions across the country were in Queensland.
So 41%, so almost half.
Yeah. So it was the most popular state up until recently. It's recently been overtaken. We'll talk about that. And it dropped to 33.6%. So a 17.8% fall in investor transactions during that 98-day period.
Okay.
So that tells you...
Sorry, it fell to 33 or 23?
It fell to 33.6.
Okay.
Yeah.
Okay.
So down 17.8%.
Okay.
So that just goes to show...
Sorry, I'll stop you there for one sec. You said 40.9.
Did I?
Then to 33.
It went...
7%, isn't it?
Oh,
8%.
no, but if you work it out from the high base to the low, and you index it, it works out to be 17.8% overall.
Okay.
So it's like a 7% drop.
Yep.
But the difference between 33 and 40 is like 17.8%. That's a weird nuance, right?
Really?
Yeah.
Okay. I was going to cut that out, listeners, but we'll leave that in because the data guys have schooled me on. I'm just going to believe him. We're just going to trust him.
That's good. Thank you. Yeah.
So other people weren't going, hang on a sec, this guy doesn't know what he's talking about.
But I mean, so like if Queensland, it begs the question, what were they trying to do?
Yes.
Were they trying to raise revenue? Well, that would have worked if it got through. If they were trying to decrease the stress in the rental market, it made it worse.
Yeah, 100%.
That to me shows proof.
Yeah.
Now, if we go to Victoria...
I'll say one thing real quick here as well. It's funny because I didn't notice that much in terms of raising the rateable land value up until that point. And then when they scrapped that, at the end of the next financial year, I got all my rateable land values and all of them had risen by like 40%. So they were like, okay, well, we missed out on doing it. So instead, we'll just jack them all up as a rateable land value.
Yeah.
And then, so they would have been, they're definitely still taking that, they're scalping there for sure.
Yeah,
they're gouging 100%. So they're
Yeah.
just doing it in the other way, the more sneaky way that most people probably wouldn't notice, but because of the size of my Queensland portfolio, I definitely took stock of that.
That would have stung.
I felt it.
Yeah. So contrast that to Victoria.
Yes.
There's been a few interventions in Victoria that have negatively impacted investor participation, like minimum standards legislation.
Okay.
Right? That was rolled out very quickly with not a lot of industry consultation. Property managers I speak to say that we were chasing our tails to try and implement it.
Yep.
And, there's an opportunity for rorts. You've got to do these annual compliance checks and then the tradies are like, you definitely need to do this $20,000 upgrade or you're not going to be You know, that stuff happens, right?
Yep.
You look at the roof insulation when that came in.
That's
that
what it
was
was,
an absolute disaster.
Yep.
But in the 2 years prior to the land tax announcement in Victoria had 9.4% of all property investment into that state. So quite low.
Yeah, very low.
Over our long-term data, it tends to be more like 16, but it's been in the doldrums because the market hasn't been performing that well.
Yeah.
6 weeks after the announcement, it dropped to 5.7%.
Wow.
Yeah.
This is when the Victorian land tax reform came through.
Yes, absolutely. So those two interventions, you can see investors are voting with their feet and they're going to other places.
Yeah.
And one of the main beneficiaries is WA.
Yeah, and to kind of, I guess, now knock that in the head as well, it's the added cost of the land tax changes and legislations that they're bringing in to making it more expensive for investors holding properties there. Yields are horseshit as it is, and values aren't increasing. If anything, the market's coming back a bit, and now we're just seeing that transition even further out of it. So you're saying now 5.4% of all transactions at the moment of investors.
Yeah,
5.7 of all investor transactions are in Victoria.
Yeah.
Okay.
Yeah.
Okay.
Compare that to WA,
Yep.
where it's hovering in the low 40s.
Okay.
You know.
So it's now taken the cake of
Number one spot.
Number one.
Yeah. So
Yep.
Q1 2022,
Yep.
it was 9%
Okay.
of all property investors were going into Perth.
Okay. 9%. Okay.
9%.
Yep.
Q1 2023, so 12 months later,
Yep.
30%.
Wow.
Yeah.
Okay.
So it just went bang.
Massive,
you know?
massive
Yeah.
shift, and now it's sitting in the low 40s. You said.
Yeah.
Talk to me about the Victorian change from say that 20. You said 2022, 23, and then 24. How has that transition come through of like that Victorian cliff, right? If we're talking about the change from that, so
Yeah.
Perth's gone from, or WA's gone from 9% to 33 to low 40s over the last 3 financial years in terms of investor shift into it.
Yep.
What's the shift been from Victorian out? If we talk about the trajectory down.
Yeah, it's been roughly 16, 9, and then down to 5.
Okay.
Yeah,
Okay.
yeah.
What was it? If you don't mind me asking, like the peak, which would have been probably when Sydney and Melbourne were both on their run in the 20 teens. Do you remember what the data was around then?
I don't think it's ever got into the 30s.
Okay, but it was.
I don't remember off
20s.
the top of my head.
Okay.
But yeah, I would have said that it would have been in the early 20s. You know, because
And it would have been competing with New South Wales because at the time, like Sydney was on a big run, but they were both on a big run. That kind of 2013, 14 run through to 17, 18. Right?
Yeah. And I think so. Victoria, I think annualized 12-month growth rate is like 0.2%.
Yeah.
Right. It's like ever so desperately neutral rather than negative, right? And I think its market peak was about March 2022.
Yep.
Whereas CoreLogic are saying Adelaide, Brisbane and Perth are at the peak. Whether that's true or not, I mean, it's the peak from COVID to now, but you know, if they re-release that in 2 months, they might say that, well, it's the peak in September or October.
I think what that is, because I caught up with Timmy Laws a few weeks ago. Obviously, he had a research over at CoreLogic, and what he was explaining to me was from from that exact perspective of like the market is now at a peak in terms of where it's ever been before.
Yes.
But they're not calling the peak of the market; they're just calling the peak of where it is right now.
Yeah.
Interestingly, which I know we're going to dive into in a second as well, he was saying that both Brisbane and Perth still have a lot of affordability left in the tank to actually continue to grow.
Yeah.
But he did point out that Adelaide, by their calculations, it was more at a peak of an income to house price ratio, which is a little bit of a worrying thing of people still buying in there. Like I would be a little concerned if I was still buying in there. And it'd more be like kind of looking at, okay, well, where do we believe the peak's going to be and the time to exit? But again, it's a tricky thing because the market's done, from memory, it was 16% growth over the last 12 months as well, 15.5%, 16% between it and Brizzy, one or the other was one or the other. So the market's still growing. So it's like, okay, so where are we calling the top, you know? And I guess it depends on whether you're a long-term hold investor or whether you're probably a APS client, where we're obviously looking to time exits, time market peaks. So
I think the investor landscape has changed and moved much more to that. I mean, like people used to do like whole podcast episodes, like is it timing the market or time in the market? And I think people, at the very least, want both. Right? Like most people understand that you need to invest over a long time horizon, but why not start off with a rip-roaring, market, getting in at the bottom and getting that upside straight away, especially if you're trying to grow a multi-property portfolio.
Yeah, for sure.
That's the shortcut, right?
I'm completely against the idea of time in the market. Like, as an investor, you want time in the market, but like, okay, well, let's talk about Perth, right? And if you bought in Perth in 2010 and picked like a great market in 20, like a great lifestyle sort of market, a great place to live and everything ticked up. The market did nothing for 10 years. So that time in the market, you could have doubled your money in Sydney, you could have doubled your money in Melbourne, you could have doubled your money doubled the property value, let alone your money that you put into the deal. Hobart, you would have doubled your money. Perth, Brisbane, Adelaide during that window did nothing during there. So it's like, it just doesn't work. You know what I mean? When you actually time market cycles, time markets, it's so much more important than just getting in and sitting in. It's a very lazy sort of approach, in my opinion. And it's just, you can do so much better than just taking that approach to it.
Well, I think Perth is the best case in point because I think it was
14
years.
It was.
Like the median house price went from like $494 to 94, 92 or something. I think in the middle of that period, it did go up a little bit, but it came back down.
Yeah.
But yeah, essentially...
And that's why it had such a stigma, the little mining blip in 2013, 14.
Yeah.
Where it went up and then it came back.
And that's what kind of worries me the most about people getting into Perth, say, now. You know, like, it's... The fundamentals are still there. Like, the listings are so tight. You compare that to Victoria. Like, you have a lot of power as a buyer.
Yeah.
In WA... You don't, right? I mean, we hear all those stories about the open homes and the shoes, you know, like just a sea of shoes, right? And like we were talking yesterday, you know, to get into Perth now, you would kind of want to be trying to get off-market things where you don't have that 100%. Degree of competition. But it begs the question, well, why is the vendor not putting onto the market when the chances are that would be better for them? But it does happen, right?
But that's what, like, so for us in Perth, the last 18 months, every single transaction pretty much would have been off-market. We might have done maybe 1 in 100 would be on market, but all the others are off-market. And it's all, and the biggest thing that people don't realise, because they always ask that question, right? And it's like, but we're not talking about 100% of people being willing to sell off market. We're talking about 5 to 10%, like a very small portion of the market that would be willing to do it. But circumstances dictate, or just their circumstances dictate that they either don't want to go to market or they tend to sell really quickly, easily. And when there's a good, solid option that's been explained to them by an agent at the time as well, then a lot of them do opt for it. And again, but I say a lot of them, it might be a max 10% of the marketplace. But yeah, taking that heat out of the transaction is absolutely vital over there in that space. So yeah, man, it's been very interesting to kind of watch it play out. But I've seen other people who have a crack at buying it themselves, and it's just like it's crazy, man. There's no chance.
Yeah,
you're paying top dollar.
Yeah,
like how do you buy over there yourself? You're paying top dollar. It's as simple as that. So
you could get in anywhere if you're prepared to pay more than anyone else.
That's it. That's
right?
it.
Yeah,
and when you go into those hot markets, that's effectively what you're doing. So interesting, man. Okay, beautiful. Anything further on that?
Yeah, well, another research project that we did is we looked at the listings in Victoria for a 1-month period, and we calculated that essentially there was over the next 12 months, there was going to be 44,000 rental properties sold.
Okay.
And the ABS lending data said that would be replaced by 40,000 investors. So, there's around about 5,000 properties lost from the property market pool in Victoria, which represents about 1% of that property market. And if you look at the ABS population data, nation grew to end of December by 3.5%.
Yep.
And Victoria is actually in second place at 2.8% after only Perth, right? So there's another interesting contrast. So whilst the Victorian market's very, very soft, it's still getting good population growth, right? And it's not going to be down and out forever. It just physically can't be. You know, you look at those monthly updates, it was always Sydney median house price #1, and then Canberra for some reason, because everyone's on $1 billion as a public servant. And then Melbourne, it was always Melbourne.
Yeah.
Melbourne's now mid-pack.
Yeah.
It's just...
If not falling towards the bottom.
Yeah.
It's crazy to watch, so like, I think that's the thing is, like, we're still in that softening phase though. And I think that's the thing for people to, that's why I kind of wanted to do this app with you when you kind of mentioned it a few weeks ago as well, was this is like, because people are talking about, well, it's now the time to sort of get in there. And realistically, it's still falling. Like, it's still going through that trajectory, downward trajectory. And there's things against it at the moment. It's bottoming. The time will come, but at the moment, it's bottoming. And I agree with you completely. It's, second biggest city in Australia as well. And it's now becoming affordable for what it is. But there's also a lot working against you at the moment too. So I think it's just like, it's time's coming, but it's not yet, in my opinion.
Yeah, it's not going to go to the point where it drifts down to Darwin, down the arse end of the median house price table. I don't know if we should trademark that statement. But, it still gets a big chunk of international migration into Melbourne, right? It's a very popular city.
Yep.
It lost a lot of people during COVID because, they world record holders in lockdowns, right? Absolutely crazy.
Yeah, they did well.
But it's not, they did well.
Did very well at it.
Yeah, well, Queensland did very well out of it. But it's not happening anymore. Like, it's fairly neutral, like, state migration in Victoria.
Yeah.
So, there's too much going for Melbourne to suddenly become like one of the
star performers.
The dodgy.
Yeah, sorry.
Yeah.
The other end of it. Yeah.
It'll come back. It's just a matter of when. But the listings data are kind of pointing to the place. Well, it's not yet.
And this is my biggest thing with it, right? Is when people sort of ask me about that, it's like, okay, but like it makes sense because of all these different factors and stuff in terms of it's still being a place that people are moving to, still got good international migration.
Yes.
So population's still growing, second biggest city, becoming very affordable for what it is. And it's like, yes, and that's pointing to it bottoming out, but it's not pointing to it like starting the run yet, especially when listings are coming more to the fore. People are still piling out of there. So it's a funny thing because like when people say, but isn't that the right time to get in? It's like, potentially, but like, do you want to make a win now, or do you want to wait for a market to bottom, still potentially fall a little bit before it starts its next rise? There's other places, better places to make money before you put your money into there too. So
that's a good point, because I've always sort of said to people,
it's the time in the market versus timing the market question again, right?
Yes, yeah, exactly. And I've always sort of said to people, if you wait for green shoots, and then let's say that market grows 10 or 20%, there might only be 80% of that growth left because the data kind of lags. So you do kind of want to get in there before you know it's a sure bet. For sure. Right? But how do you do that before the data's telling you? I mean, there are some clues, there are little whispers, and I think listing activity is a big one, and it's up in Melbourne, and it's just tight as anything. And you look at, say, things like age listings in Perth, I think it's down like 66% over 12 months. Like that's the listings that are on the market for 180 days or more. Because if you think about Perth, like what's on the market for 180 days?
It'd be land, man. That'd be the only thing. You know what I mean? Like land that the developers just leave on the market because they bring new releases. Like Perth it's everything's sub 10 days. Like realistically, if something's priced properly, it sells in 24 hours. Like sometimes they leave it for a week just to let 50 offers come in. But most of the time things sell in a day on market. And I think that's the crazy thing. And if we look at listings as well, when Perth was like at its bottom just before it turned, so we entered late 2020, the market kind of turned late 2021, mid to late 2021. We were talking about this last night. And listings at the time were about 13,000 across the city, right? They're currently at sub 4,000. So we're sitting at like in the low 3,000s listings across the state, across the city, compared to 13,000, which is like the bottom. So when listings are that low, there's that much heat, competition, everything there. Vacancies are still super tight. It's just a complete fire under that market. So whether it's a right market for someone or not is another question, another debate. It's another show. Mike there inviting himself back on. You guys will have to let us know if you want him back on for that show.
Mum, quick, get on.
Mum, get the accounts going. But yeah, man, I think it's interesting to weigh up against it, So, but yeah, man, as time's coming back around in terms of Victorian market, it just kind of depends when.
Yes.
It'll be interesting.
And you were talking about affordability before, and here's something I prepared earlier.
Oh, okay.
We've got a new research project that's it's going to be a News Corp exclusive thing, so I've got to be careful about how much we share. But
we're going to beat them to the punch. We're going to drop this afternoon and beat those guys.
Oh dear, yeah. Sorry, guys. What we looked at is trying to find affordable markets within Australia, and what we kind of termed affordable is in that bottom 25 percentile of listings or sales. And then comparing that to
value-wise, right? Value-wise. Yep.
And then comparing, or it's sort of listed for sale price. Right?
Yep. In the bottom 25% of that market,
of all of them. Of that city. Segmented into houses and units, but we'll focus on houses for a moment. And then we looked at the average double income household, which was $120,000, and then worked out, well, what is the multiple of how many years would you need to bank that $120,000 to get into that bottom 25%? So Sydney, no surprise, it's 6.9 years. And that's 6.9 years of earning 120 grand a year and not spending it. Like not spending a cent, right? You compare that to Melbourne, it's 5. Greater Brisbane, 4.9. ACT 5, Hobart 4. Interesting, that's the lowest. So there's maybe an argument to say that its time in the back of the pack is going to end eventually. Adelaide 4.5, but Perth 4.2. It's still the second most affordable. Because incomes are fairly good in Perth. I mean, the resource sector, I think its record was 2 years ago, but in 2013-14, I still think the take was pretty significant.
Yeah.
And you look at the federal budget where, there was this surprise surplus. There were two reasons for that in my view. One was unemployment rate was a lot lower than what they expected, so there's more tax revenue, less welfare payments. And then it was just they undercooked the value of resources.
Yeah, right.
I think they were around about 50% down on what they thought the spot price would be for thermal and coking coal and iron ore and that sort of thing. I think coal's doing better than iron ore at the moment. That's another show. I don't even want to be on for that. It's not my area of expertise.
We're not putting anyone on for that. So.
Yeah, good. That's too boring. I mean, we did the tax depreciation and we got away with that.
We got away with that one, but
can be boring as hell.
We'll leave other people to debate that one and bring that one to the table.
So that's interesting when people say like, well, Perth is at the peak or it can't go any more. Like it's grown like it's ostensibly 25% in 12 months. That's bananas. Yeah. It's doing like 2% a month. Yeah. Like it's over 6% in the last quarter.
But that's as a median for the city. So then if you drill that down to actually specific regions, some of the regions have done 30 to 40% in that time frame, which is crazy. But then you drill into the mix. Exactly what you're saying there is you're at 4.2, right? So we're almost at, let's round it down for the sake of the argument for half a second to almost 4%. And then Sydney's at 4 times, and then Sydney's at 7 times. So you're at say 60% affordability ratio compared to Sydney for the same pricing. So you've still got effectively 40%, and then that's from an income to house price ratio sort of jump, just to break even with Sydney from that side as well.
Sydney is weird though, right?
Yeah.
Like I don't think Perth would ever get to that sort of multiple because Sydney has a bit of an X factor, like internationally. It's a place where people want to be. There's a lot of prestige, and there's a lot of intergenerational wealth transfer.
Yeah.
I remember.
But you're talking the bottom 25% of the market though. We're not talking the middle or the top. We're talking the bottom 25%, which realistically is probably your Aussie battlers and all the rest, or just your standard Aussie people on that that median couple income and what they can afford, like what most people are getting out there into the marketplace. And realistically, that's the majority of the time what your first home buyers and whatnot are getting out there and starting with. So I agree with you that Sydney is a bit of a different beast, but at the same end, like you've got the bottom segment of the market, which most of the time are those first home buyers coming in that are pushing for pushing at that same product, right? So I hear what you're saying with it, but I just feel like it has more juice, if that makes sense.
Oh, I think Perth definitely does. Whether it would get to that same ratio that Sydney does, that's up for debate, I suppose. Because it does have that X factor. It's got that bloody bridge and that pointy building everyone loves, and Bondi. I love watching those shows where everyone comes from overseas and their first trip is to Bondi and they drown themselves. It's ridiculous.
But it's true, huh? It's it's an interesting thing, man. But even if it goes within touching distance of it, I think the steam, like the momentum in that market as well, it's just there's just so much there to go. So that'll be interesting to watch, man. But okay, so that's I think at time obviously of recording, different to time of release. This should be out. So where do they go to find that report?
Yeah, that'll be hosted on our website, so mcgqs.com.au/research, I think it is. And we normally try and have a research project once a month. So when I was talking about the ex-rental properties for sale in Victoria, we compared that nationally. Victoria was the most depressing case of all of them. That was a release that we did previous. And we just like to do that sort of once a month. We have a few thought experiments, or maybe have a couple of beers with someone like yourself and go, I wonder what's happening with this sort of stuff, and then we do, and we just throw it out there as interest. And I like investigating and interrogating the property market. It's not what I do for a living. I'm just a tax nerd, but I love property as much as anybody. Yeah,
100%. Okay, so so go check that out, guys, if you want to look into that as well. I think it'd be cool, man. I'm definitely going to check it. Just send us it over once it's out, would you, mate?
I got a special version right here.
Oh yeah, there we go. Put the
juicy one.
Super juicy. Mate, thank you very much. I think, mate, that's pretty much everything I had on my little list that I wanted to run through with you and kind of unpack today. It's cool to kind of get the data points across the board, and that's the point of the APS, like the weekly news bulletin that we run through as well. It's really kind of of breaking down different data points and things that we're seeing. And so when you kind of had this coming out, it's kind of the two parts, right? Obviously, what you're seeing from that 25%, the bottom 25% of the market, from an affordability ratio perspective, I really like that. And then obviously what we're seeing from a state and a city perspective, you know, of movement in the markets and whatnot too, man. People going in, going out, and where that investor trajectory is too. So, mate, I appreciate you coming on and joining us. But I've got a final thing I want to pick with you as well. We talked about it last night over a few margaritas. We both got fired up, and it's something I want to bring to the table, man. Of I guess here we go. Yeah, here we go. I want you to fire up again. It was talking about the difference, and for a long time before I used it, I tried a few different sort of depreciation companies sort of thing. And you were telling me now about, like, there's a lot of them that are just using mapping, right, or photos online. Almost just like you could use people virtually trying to depreciate homes, right? As opposed to physically going in there and writing off and being as comprehensive as possible with the reporting schedules, which obviously is more dollars in the pocket for the investor if you guys can find more stuff for them to write off. Do you want to run me through like a little bit around that as well?
Well, there's a new industry white paper that came out from the Australian Institute of Quantity Surveyors, and I was one of the panel that sort of was putting that together, and I presented that to our industry, and it basically said there's very specific reasons that you might not be able to, or might not need to inspect a property for a report, but they're few and far between. The best example is a brand new property that you actually build yourself, so you know the exact construction.
You have the contract,
exactly, and you have all the fixtures and fittings. But you know, there's a few quantity surveyors out there that they can sort of, they might say, like, look, we'll do it online, or we'll have an option to do an inspection. We don't do that. I think it's dodgy. It's a real bad part of the industry that I hope that people will become wise to. Because it's cheaper. It costs money for us to send an inspector to a property. But there's two quick anecdotes. One, I was in a property not that long ago, and I said to the owner, "Oh, this place has been extended." And they're like, "Oh, really? Like, how do you tell?" Well, I can see this is where the rear wall was, and we look under the house and there's stairs going up to the middle, which is a very untraditional way to enter a house, burrowing through the floor, you know. And at the Accounting Business Expo, an accountant came up to me and he said, "I got a report on a service station." I'm like, "Oh, yeah, that's good. There's great deductions in service station." He said, "Yeah, what was weird though is that, like, it was demolished and rebuilt, and I got the report for the client that rebuilt it, but there was a photo on the front and it was the old one. They didn't go to site on this property." No way. Yeah. So, I mean, that gives me the absolute shits, to be honest, that happens in my industry. I hate that. And it's just greed. It's just people trying to...
It's cost cutting, right? Like, it's cost saving rather than looking at, like, the best result they can kind of get for the client. It's just like, okay, well, how do we shave off as much as we can here or there or whatever to kind of to save those costs?
And everything's become more expensive in the last little while, like with inflation, you know.
Wages growth across the board.
You know, our prices remain the same because there's so much pressure. It's a real kind of race to the bottom. There's a minimum amount of time we need to spend on a report to be able to look ourselves in the mirror and say, we've done the absolute best that we can for the client. So we won't compete beyond that, you know, because I would rather do something else.
I get you.
Than just do substandard, phone it in crap. And the real problem is the investor doesn't actually know. Like, they get the report and they go, "Oh, deductions, that's good." Could there have been another 20%? Like, if they'd got someone to inspect the property and realised that it had been renovated, but the photos didn't show that.
Of course.
I mean, that's crazy.
Because so often that happens as well, right? Like, even the majority, like, I look at what we buy. I think there's been 1 month out of the last 18 months, since the start of 2023, and we're almost in Q4 of 2024. So, it's like a 18 odd month plus 20 odd month sort of window. There's only been 1 month that we fell below 90% off-market transactions. So we typically sit like 90 to 96 per month. And there was one, I think it was in February or March, when there was remember that big listing hit that everything came through? We started 88 that month. So we almost, right? So 88 to 96% off-market every month. And so much of what we buy, the photos and the videos that we get that the agents will go and take for us, is not what's actually online.
Well,
like,
and
what's
you don't
online
put them on the internet, right?
No.
Because it only gets attached to a sales campaign or, let's say, a rental listing. That'll go online. And it's great that there is that resource of photos. And we use it as well to look at historical things. We go, "Oh, I can see that there was a photo in 2011, there's a photo in 2012, and there's a new kitchen in 2012, right?" we crunched the numbers back in 2017, and of all the properties built pre-1987, 69.9% of them had been renovated.
Wow.
Right, so it's a vast majority of established properties. So there's
More
a
than
real
two-thirds,
opportunity to miss stuff, and that's money. It's money in your pocket, and that keeps me up nights.
Yeah, man. Yeah, I remember, and when you were talking to me about it as well, you were telling me about some other big boys in the industry that you'd had some big phone shouting matches with as well, which I can understand, man, because I think you know very well. I get fired up about different people in the industry in our game doing the wrong things as well, so I can completely relate to it. So man, like I wanted to bring it up because obviously everyone knows that I have you on the poddy, mate. I always give you a shout out when we ever talk depreciation as well. But it's like when I look at the difference, and I get all my stuff depreciated through you guys, but when I look at the difference around that side of things, there's so much that can be missed, especially if you're building a multi-property portfolio. Like you say, 20%, it could be fall between 10 to 20% in a report, and the report's pretty much across the board. They all cost the same from the different guys. But if you're missing 10 to 20%, like that can really add up, especially if the portfolio starts getting bigger. So
you got to trust that expert cares about you, cares about the consumer, cares about the outcome. You know, and unfortunately, not everyone has that kind of moral compass.
Yes,
you know?
yes, like you and I.
Yeah,
we're very compass oriented.
Yeah, and I think like it gets to a point where the sum doesn't matter. There's no amount of money that would make me kind of want to sell out. Like I always sort of say, when I look myself in the mirror, I'm already annoyed because this is what's staring back at me.
It's not the best.
I don't want to. No, I know it's a fair call, but I don't want to make it worse by going like you're ugly and you're an asshole. You know? So I'm not sure if I'm allowed to say that.
No, that's okay, man. It's okay. There's a few boys in my industry that would have that same conversation, I think, with themselves every day. So
thanks for the compliment.
No worries, man. No worries. Magic Mike, it's been a pleasure. It's always a pleasure having you on, mate. So thank you once again for jumping on and joining us, mate. Any final words?
Pleasure. No, thank you. I just wanted to say thanks for the support and congrats on the success of the show. It's just going from strength to strength. So it's great to be watching from the sidelines.
No, it's a pleasure, mate. It's a pleasure having you on, having you as part of it, mate. So, Magic Mike, thank you very much for joining us in the studio.
I'm definitely tuned in.
Too many margaritas. That's it. Listeners, I hope you took some great value from that episode. If you did, make sure you send it on to someone else that also might take some great value out of it. If you haven't followed us yet or subscribed to the channel yet, make sure you hit the follow or the subscribe button on your favorite listening platform. And if you're not following us yet on the socials, make sure you jump over to @Australian Property Scout or @Scouting Australia Podcast. Follow us over there. And until next week, guys, that's another Scouting Australia podcast.
And cut.